So again, we're just talking about like general macro concepts right now. We're talking about the business cycle specifically. I started talking about how there are recessions and how there are expansions in the business cycle. So again, you can have periods of economic downturn where the measure of how well the economy is doing is decreasing. So you could be talking about like the output in the economy that could be going down. So that'll be a sign of a recession. Or you could have that increasing over a given period of time, and that'll be a expansion or recovery. Um, and again, the business cycle itself is the short run alterations between recessions and expansions. And of course, if the economy is increasing at some point and eventually starts to decrease, then it has to reach some sort of peak, right? And so then you'll have a business cycle peak, a point at which the economy turns from an expansion to a recession. So this will be like a peak here. And then, of course, you'll have like the bottom points, the points where the economy will turn from a recession to an expansion. So here we've got a trough. That's what they're called, business cycle troughs. The point at which the economy turns from recession to expansion. We got one there, we've got one there. So here we had an expansion, and then there's a peak, start to get into a recession, there's a trough, another expansion, get to a peak, recession, trough, expansion. So those are the parts of the business cycle that make up the business cycle, and that's how you describe them. So whenever there's a prolonged expansion, books and articles proclaim that the end of the business cycle has happened, but the business cycle always comes back. So you might have a period of 10 years where things are going really well, and everybody's like, oh, I guess no more business cycles. We'll never be in a recession again. And then all of a sudden, bam, something happens, and we start sinking. And that generally tends to happen every time there's like these periods of expansion. And it has a lot to do with just like attitudes toward what's happened in the economy, because that will affect what will happen in the economy, just like the paradox of thrift. If people think that the economy is going to go into a recession, then they may actually cause a recession by stopping to spend. If people think the economy is going to continue to flourish, then all the big investors in the world will continue like pumping money into the economy, which will continue increasing our output, the amount of production, which will continue an expansion. But if all of a sudden like the general consensus is like things might start going wrong, then that itself will be something that will cause us to go into a recession of sorts. So it's a very unstable thing, this business cycle. It's very dependent on us, the animal spirits that guide us. Again, that's the part of us that's not logical, that's just kind of like driven by like anxieties or like just spur of the moment decisions. Like that can cause problems. Yes. So it's not like a concrete sort of definition, but the long run is generally thought of as like a 10-year period. So if it's less than that, then you can think of that as a short run. We can define short run and long run in different ways in economics, and it's all about the context you're working in, and it's usually going to be defined explicitly for you. But that's a great question. Alrighty, so here we are once again as far as like what's been happening for us, the U.S. over the periods from 1985 to 2014. So here the measure of how the economy is doing is private sector employment, so the amount of people that are employed. And we see that the economy was overall in a positive trajectory, like an expansion, over this period from 85 to 90. And then we hit a recession in the early 90s. And then we had an expansion for a very long period of time, all the way until the early 2000s. So this was primarily driven by the technology boom, the dot-com boom of the era, when this was the proliferation, the growth of the internet and like websites and all these like online businesses, things that had never existed before. All of a sudden they did exist, and there was all this money coming out of everywhere because there was all this opportunity that had never been there before, and that drove a lot of the expansion. And then we had a brief recession post 9/11. and just around the time they kind of thought, well, is the dot-com bubble bursting? Like, had prices for like these internet companies gone up too high, and now people are like starting to retract and realize the value isn't there. So that was partly what caused that recession there. And then we had a bit of an expansion again, again driven by just like the new technology era that we've been living in these last couple of decades. And then, of course, in 2008, we had our major Great Recession. And then now we're experiencing an expansion again. So this is what's been happening as far as like our economy over the last couple of decades. But again, and again, there's no way to really say like things will happen in this way over 10 years or 20 years. Like expect this or that to happen. Like you just never know. And so all the government can ever do is kind of like monitor things. And if we see signs of trouble, then we try to like jump in and like try to do stuff to kind of like smooth out the cycle. Like by smoothing out the business cycle, we mean like, try not to have like these like troughs and peaks, but just always kind of be like somewhere like in the middle. Obviously, recessions can be ugly. So the most important effect of a recession is its effect on the ability of workers to find and hold jobs. That is the biggest problem. So, in 1930s, we had huge unemployment rates. People just unemployed at numbers we hadn't seen before, with huge lines at food banks. The most widely used indicator of conditions in the labor market is the unemployment rate. So you often hear about the unemployment rate in the news. And this, of course, is the big signifier of how the labor market's doing, which again is a big metric that tells us how the overall economy is doing. So the unemployment rate here, you can track it throughout this period that we've been looking at in that last figure. And again, you've got the unemployment rate going up during times of recession. So early 90s. Early 2000s and 2008. 2008 especially, we saw the unemployment rate go up pretty high. Fortunately, things have improved now. The unemployment rate is close to what's called full employment now. We're going to talk specifically about the unemployment rate in a few chapters. This is a chapter dedicated to unemployment. We'll talk about how it's measured. We'll talk about the various types of unemployment and the trends that we've exhibited over the last few decades. So recessions, they hurt the standard of living of many families. So, the ability of people to just basically take care of themselves and have like basic necessities or like, luxuries, things of this sort. Obviously, that recessions do tend to hurt that. Recessions are usually associated with a rise in the number of people living below the poverty line. So, the government defines what the poverty line is. I think right now it's like something like $14,000 for like a single family. And so if you're making less than that, you are below the poverty line. And of course, recessions do drive people below that line. There's also an increase in the number of people who lose their houses because they can't afford their mortgage payments. There's also a fall in the percentage of Americans with health insurance coverage. Obviously, things have changed since Obamacare, but still, I mean that hasn't helped everybody, and recessions will still harm people's ability to have health insurance. Recessions are also bad for firms, right? Businesses are closed forever. Some some go out of business. Some have to severely pull back in terms of like how many people they're hiring and how much they're producing. Their profits suffer during recessions, with many small businesses failing, as I said. So as far as like defining these things, there's no exact definition for expansions and recessions. In many countries, economists do adopt the rule that a recession is a period of at least 2 consecutive quarters. And a quarter is measured as 3 months. So obviously quarters, a fourth, so we're breaking the year up into fourths. So a quarter would be 3 months. And that's usually how we measure most macro variables, like in quarters. So again, if you have 2 consecutive quarters of a decline in these measures that either either measure output or unemployment, then we could say that we're close to a recession. Now, having this definition helps us to avoid small hiccups. So you might have, one period of time in which you have a decline in output, and that is, and by having this kind of like formal definition that the governments use to define the recessions, it helps us to just not be so reactionary with respect to like small movements that might be happening because of whatever things that could be fixed and are fixed, and then so you'll usually see a rebound and an expansion happen right after like a one period recessionary period, and therefore we would not call that a recession. But also it can be too strict to consider two consecutive quarters to define a recession. So you might have 3 quarters of contraction, let's say, followed by 3 quarters of expansion, followed by 3 quarters of a contraction. In that case, because over that period of time you have 3 quarters of expansion, you would say, well, we're out of this recession. But if indeed that is followed by another 3 quarters of a contraction, then it's likely that we've been in a recession the entire time, and that small three-quarter expansion was not an expansion. It was just a result of some temporary movement within the economy that caused us to slightly bounce back. So in the U.S., the definitions for whether we're in a recession or an expansion are determined by the National Bureau of Economic Research, one of the departments in the government that deals explicitly with the economy and measuring the economy and doing all sorts of things to either try to understand the economy or try to guide it, etc. So this panel, the National Bureau of Economic Research, looks at a variety of economic indicators with the main focus being, of course, on employment and production. How is employment operating? How is production operating in the economy? If we have 2 quarters of those measures declining, then they'll decide collectively we are in a recession. They will announce it, and it will be official. So again, ultimately, the panel makes a judgment call about whether we are in a recession or not, even though you will hear in the media, all sorts of pundits, like talking heads, like, sounding the alarm with respect to, some signals that aren't officially definitive of a recession, and that could potentially lead to a recession because people will react to that. So that's dangerous, but overall, at least the major media outlets will tend to listen to like the NBER with respect to like what's actually happening and report that. All right, so the 2001 recession was milder than the 2007-2009 one. So again, there was a small recession in 2001 around the time of 9/11, and that was one that sort of had us like have a sort of a quick rebound. So months after recession began here, remember a quarter is 3 months, so 2 quarters would define a recession. So that at this point here, you can see we are officially in a recession. And then at this point here, you can see that we started to rebound, whereas with the 2007-2009 Great Recession, that did not happen. And so we continued on until this point here, which is about almost 2 years after the fact. All right, anyway, taming the business cycle. So again, like these short-term movements of the business cycle can severely affect like the living standards of people. It can severely affect businesses. It can severely harm like just our overall state of being as a society. And so we have to be actively sort of trying to tame the business cycle, smooth out the business cycle. So the havoc wreaked by this 1929-1933 recession, which is the Great Depression, spurred economists to search both for understanding and for solutions to such a problem. John Maynard Keynes suggested that monetary policy, again, the expansion or contraction of the money supply, and fiscal policy, taxing and spending policy on behalf of the government, could be used to mitigate, make better, the effects of recessions. Later work by another economist, Milton Friedman, led to a consensus that it's important to rein in booms as well as to fight slumps. So if we're in too strong of an expansion, then that can be a problem as well. and we'll talk about why that is. But this other economist, Milton Friedman, was sort of the guy that defined the policies that are meant to sort of rein in the economy when it's heating up too much. So modern policymakers try to smooth out the business cycle by employing both of these approaches. Although they haven't been completely successful, it's widely believed that policy guided by macroeconomic analysis has helped the economy become more stable. So just a quick multiple choice question. Business cycle phases. The sequence of business cycle phases is A, business cycle peak, business cycle trough, expansion, recession. B, business cycle peak, expansion, business cycle trough, recession. C, business cycle peak, recession, business cycle trough, expansion. Or D, business cycle peak, expansion, recession, business cycle trough. How many of you think it's A? How many of you think it's B? How many of you think it's C? How many of you think it's D? All right. Well, B it is. So I'm kidding, guys. It's C. C is the correct answer. Good job, folks. So just an example of a multiple choice I may give you, reflecting what we just covered. Yeah, sure. So business peak, recession, business cycle trough, expansion, as the diagram shows. We have an expansion, it gets us to a peak, then we have a recession, a trough, and then expansion. All right, let's talk about long-run economic growth, not these short-run movements of the business cycle. So again, the long-run economic growth is what has changed our world. It is important as far as like macroeconomic focus, and it really it's both of these things that are the focus of macro, both long-run economic growth and the short-run movements of the business cycle. And we have models that are different that independently deal with both things. And we will be covering those models throughout the course. They can get complicated. They will have a lot of moving parts to them. So just remember, that's coming. And it's just, you have to really be in tune with this stuff as we cover it. You have to really practice it and go over it several times to really understand it, because it's foreign to you. It's things that, A, you don't think about on a normal basis, and B, definitely would not think of on your own. So anything like that requires a lot of time on your part to get down. All right, so long-run economic growth. So long-run economic growth, just formally defined, is the sustained rise in the quantity of goods and services that the economy produces. So again, just looking at the last century, here we have on the y-axis, we're measuring the percent of homes with products. So in 1905, electricity, like a range, like a gas stove, telephone, automobile. Barely anybody had any of these things in 1905, which seems like a million years ago, but really it is pretty recent if you think about like human history. So as far as like our civilized societies that we have, like we've only been operating like this, where we have like these settled areas where we live and build and grow for about 12,000 years roughly. So 10,000 BC is when it all kind of started, when we like kind of settled and said, you know what, we can actually stay in one area, not be nomads, because before that it was all about like nomadic lifestyles, like moving through areas and like in tribes and like kind of like surviving off the land. But then what happened was like we developed certain tools that allowed us to cultivate the land. And so then we started to settle down and actually establish, like colonies and like just places that, that a society could flourish. And so we did, that happened. And then, over the course of the last 12,000 years, we got to the point we're at now. So that is a very small portion of like the history of the earth and also the history of humankind. We go back a lot further than that. So really like this thing that we do together, where we just like live in a civilized state and we're not killing each other and we're like doing what we need to do for ourselves, but also, helping each other in an indirect way to kind of collectively thrive is still very new. And so if you just think about like 100 years period, that's just a blip in that whole like time span. So really, like, this is just yesterday. This is so recent that, like, things were completely different for people in the United States. And then in 1955, you see that obviously electricity went up dramatically. Phones, automobiles, refrigerators, air conditioning, but still, like, air conditioning, most people didn't have. Washer and dryers, people kind of had. Dishwashers, almost no one had. Obviously now, this is even from 2005, so we're even further than this now. But obviously, all these, like, original items that were innovated early, most people have, and now, of course, now most people have, like, air conditioning, washer, dryers, dishwashers, which are represented by these bars here. And then over here, we've got all the latest innovations, including microwaves and computers and cell phones, internet, digital cameras. Anyway, life has changed dramatically as a result of long-run economic growth. So part of the long-run increase in output is accounted for by population and workforce growth. So that's one of the things that could lead to long-run economic growth. So here we've got the real GDP per capita. So that is the amount of output produced in our economy, adjusted for inflation. Things that we will talk about as we move forward. Be very specific about that, so don't worry about it yet. But you see that the amount of output per person, that's what real GDP per capita is, has dramatically increased over the course of 113 years here. Now, so this is the long-run economic growth. And these fluctuations that occur along the way are the business cycle. So, like, if you just zero in on one area, you'll see ups and downs. And within that, you'll see, peaks and expansions and troughs and recessions. You will see business cycles. But the entire thing is not a business cycle. It's more of just like an upward trend, which again is reflecting our increasing ability to produce more goods and services. Long-run economic growth. So the economy's overall production has increased by much more than the population. So it isn't just population and workforce growth that has caused our modern long-run economic growth. Long-run growth is an even more urgent concern in poorer, less developed countries. So in China and India, places like that have just a few decades back, like, had, like, large percentages of their population in poverty, have had, like, this need for modern economic growth as sort of like a means of, like, mitigating that and improving that. And so they've actively been trying to have this happen to them over a much shorter period of time. And they've been able to do that because, it didn't take them, like, 100 years to develop, like, like internal combustion engine and, like, digital technologies. Like, they just had all these innovations available to them that had not been implemented on a wide scale throughout the entire population all at once. And that has caused their growth rates to increase dramatically. So if we were to track their growth over even a shorter period of time, you would see a much steeper curve representing a much faster rate of long-run economic growth for those countries. So understanding long-run economic growth is one of the main concerns of macroeconomics, and thus we will focus on it in this course. Macroeconomists don't use the same models to think about long-run growth that they use to think about the business cycle. So what's good in the long run can be bad in the short run and vice versa. The paradox of thrift is an example of that. An attempt by households to increase their savings can cause a recession. Higher levels of savings play a crucial role in encouraging long-run economic growth. So in the short run, if people are trying to save money, then that could lead us into a bad time period. But again, like, if there are a lot of savings in an economy, then that will help the economy to grow in the long run, because that's how we fund investment. Inflation and deflation are two important subjects that are also dealt with in macroeconomics. So in January of 1980, the average production worker in the United States was paid $6.57 an hour. By January of 2014, the average hourly earnings for such a worker rose to $20.18 an hour. So hourly earnings have increased by 207% over this time period from 1980 to 2014. The price of eggs only went up by 128%. The price of roast coffee went up by 57%. White bread went up by 172%, and gasoline went up by 204% over this period. So inflation is how we measure it is the rising overall level of prices. And deflation is a falling overall level of prices. So we've experienced a lot of inflation with respect to prices in our economy that is reflected by this chart here. So understanding these fluctuations is another main concern of macroeconomics. We have another chapter specifically dedicated to inflation, so we'll talk about it in fine detail when we get to it. An important tale here of two countries is that of Canada and Argentina. Both of them began the 20th century looking like twins. Basically, both were at the same point where it just seemed as though Gesundheit, they were both going to sort of like, just be launched into like modern economic growth. But political instability and high inflation slowed Argentina down. So today, Canada's standard of living is on par with the U.S., which is 3 times as high as Argentina. So Argentina, because of inflation, in large part, it was actually stunted as far as its ability to take advantage of economic growth. So let's talk briefly about the causes of inflation and deflation. So supply and demand can only explain why a particular good or service becomes more expensive relative to other goods or services. It can't explain why the price of chicken has risen over time in spite of the fact that chicken production has become more efficient and that chicken has become substantially cheaper compared to other goods. So the fact that the production of chicken has become more efficient and it's become cheaper relative to other goods would explain movements within the individual market. But the fact that the price of chicken overall has gone up over time can be explained through inflation. So in the short run, movements in inflation are closely related to the business cycle. So the business cycle that we looked at could explain that. In the long run, by contrast, the overall level of prices is mainly determined by changes in the money supply, the total quantity of assets that can be readily used to make purchases. That's what we call money. Money is not just like currency. We have very specific definitions of what money is. We'll talk about that when we get to monetary policy. Hyperinflation, in which prices rise by thousands or hundreds of thousands of percentages, invariably occurs when governments print money to pay a large part of their bills. So that's partly what happened with Argentina, is they just like started to print too much money, and that's what caused inflation to occur, and that's what stunted their growth. There is pain to inflation and deflation, so there are reasons why we don't want prices to go up too high. Both inflation and deflation can pose problems for the economy. Inflation discourages people from holding on to cash. So people won't want to hold on to money if there's a lot of inflation. In extreme cases, people stop holding their cash altogether and turn to barter. So when you have a case like in Argentina where you had hyperinflation, or in a lot of developing countries that have hyperinflation, currently Venezuela is experiencing hyperinflation, then in those cases, obviously, the value of the individual currency tends to drop almost to nothing. And so in that case, then the real value of goods, like the trade value of goods, so like the value of apples in terms of how many oranges you can get for it, is what ultimately winds up mattering. And the price that's on the store shelves don't matter anymore, because those tend to fluctuate too much and ultimately wind up meaning nothing. And so then people then just start to trade actual goods again, which is a problem, because economies function better because of currency, because we have these things that allow us to then trade without physically having to bring like everything we have to a market to trade for the things we need. We'll talk about the nature of money and like why it's helpful and everything related to money later on in the chapter. That's going to be one of the chapters that's going to really help you to understand a lot of the important, most relevant aspects of the macroeconomy to you. So deflation can also be a problem, and that is the reverse of inflation. Of course, that's when the price level is going down. So if the price level is falling, then cash tends to gain value over time. So that means that holding onto it can become more attractive rather than investing in new factories and other productive assets. So, so if we have deflation, then that tends to be one of the sources of sort of contracting the economy's ability to produce, because investment doesn't occur when inflation is happening. So price stability is a goal of macroeconomics. And price stability is basically a situation in which the overall level of prices is changing, if at all, only slowly. So that's, again, a target of macro policy. So in general, economists regard price stability as a desirable goal and try to make it happen. All right, so a fast food measure of inflation. So we can look at, like, let's say in 1954, the original McDonald's, they sold hamburgers for 15 cents each back in the early days when life was only in black and white, as you see. In 2013, the same burger sold for $1, which is 6.5 times higher than it was then. But overall, consumer prices rose even faster to 8.5%. So even though a burger cost 6 times more than it did in 1954 when McDonald's first opened, it's still a good bargain compared to other consumer goods. And in fact, there's this interesting index that the Economist, so the Economist magazine is like the magazine that like describes what's happening in the economy. It comes out once a week. I read it every week. There's lots to read. It's like very dense. But if you want to like keep up with what's happening, like the real big movements and like the smaller movement, because it talks about like industry movements and things that are like the most relevant to anyone that's interested in what's happening in like business, what's happening in the international economy, then I would recommend like getting it. It's actually relatively expensive. I pay, I think, $30 a quarter for it. So every few months, like, I'll see that bill on my iTunes bill or whatever. But this informs me. It tells me exactly what's happening, and I feel like I know, like I get it. I'm not able to read everything, but they have nice sections at the beginning that kind of sum up like what's happening in the economy, what's happening in businesses, what's happening in politics throughout the world. And just reading that is enough to like kind of like give you the the knowledge you need to like have like just a pretty strong understanding of what is happening in the world, what could be affecting you, what could be affecting tomorrow. And anyway, they do like this measure, I think once a year, where they like track the price of a Big Mac across countries, and it's meant to sort of give us an indication of like inflation in those countries, and also like how their currencies are behaving, and if things are overpriced or underpriced. It's like interesting. It's kind of like a fun thing, but it has a lot of information to it. That if you ever come across it, you would probably like if you pay attention in this course and are able to understand it. Anyway, so finally, let's talk about international imbalances, the last sort of introductory topic in this chapter that lays the foundation for what we're going to study in the course beyond this point. So the United States is an open economy. We trade with other countries. An open economy is an economy that trades goods and services with other countries. In 2013, the United States ran what's called a big trade deficit. So a trade deficit happens when the value of goods and services bought from foreigners is more than the value of goods and services that it sells to them. So we're buying more from the world than we're selling to them, so we have a trade deficit. And that's the opposite case of a trade surplus, when the value of the goods and services bought from foreigners is less than the value of goods and services it sells to them. So here we've got a chart showing us what's happening with the US, Germany, China, and Saudi Arabia with respect to their exports and imports. So exports are things we sell overseas, imports are things we buy from overseas. And we can see that the U.S. is importing more than we're exporting, so indeed we do have a trade deficit. Germany is exporting more than it's importing, so they have a trade surplus. China as well has a big trade surplus. They're a big sort of provider of goods throughout the world right now, and Saudi Arabia as well. And this is mainly oil, of course. Trade deficits and their opposite, trade surpluses, are, again, macroeconomic phenomena. There's no simple relationship between the success of an economy and whether it runs a trade surplus or deficit, but it is an indicator of how the economy is doing. And we'll look at right now in the next chapter how it plays as an important role, as an important component of overall measures of output in the economy. And that's really where its importance falls, which is within that measure, which we'll talk about right now soon, after this slide, actually. So microeconomic analysis tells us why countries trade. So that's what that comparative advantage model told us. But not why they run trade surpluses or deficits. So the determinants of the overall balance between exports and imports lie in decisions about savings and investment spending, things that we'll cover in chapter 19. All right, so again, like I mentioned, chapter 6 is just meant to introduce like the big topics that we're going to study in this class. So really just understand the terms, the concepts that we covered. Again, like I'm not going to ask you ever like to tell me like what happened during this period of time, you know, or like things of that sort. Like any information I'm giving you like that provides you insight into a particular period of time is mainly meant to provide you context for the concept that we're learning, just so you understand it better. So again, this class is about understanding the tools, how they operate, the measures that we use, how we measure those things. So the terms, like just the big concepts, are the things you should be focusing on. And again, if you want to have a clear understanding of like what I'll be testing you on, just check out the exam, the practice exam I have on Moodle. It gives you an idea. All right, we've got some time, so let's jump into Chapter 7, GDP and CPI, tracking the macroeconomy. So what we'll learn in this chapter, we'll talk about how economists use aggregate. So aggregate measures are measures that combine individual parts into a larger whole. So we aggregate the individual behavior of, you know, maybe firms or individuals into like the larger economy measures to track the performance of the economy. We'll talk about what gross domestic product is, GDP, and the 3 ways that we can calculate it. We'll talk about the difference between real GDP, which is inflation-adjusted GDP, and nominal GDP, which is GDP that's measured in today's dollars, and why real GDP is the appropriate measure of real economic activity. We'll talk about what a price index is and how it's used to calculate the inflation rate. So again, one of the big questions is, how do we measure an economy? So in 2010, the headline is here, China passes Japan as second largest economy. But the question is, how do you compare the sizes of 2 economies when they produce different things? Well, we compare the value of their production. We compare the value of their output. So gross domestic product is the most important and common way to estimate an economy's size. All right, let's get into GDP. All right, so almost all countries calculate a set of numbers known as the national income and product accounts. The national income and product accounts, or just the national accounts, keep track of the flows of money between different sectors of the economy. The accuracy of a country's accounts is a reliable indicator of its state of economic development. So in the United States, these numbers are calculated by the Bureau of Economic Analysis, a division of the U.S. government's Department of Commerce, the BEA, the Bureau of Economic Analysis. So recently there was an article in the Economist about like the Chinese measures of GDP and how we can't trust them. So all signs point to things kind of being weird as far as like how their economy is behaving. except for the numbers that they're showing us in terms of like their GDP. Like the GDP numbers are telling us everything's fine, but other indicators are telling us things are kind of weird. And so what the article talked about was like how like other institutions, be they non-governmental organizations that track the economy, like think tanks or hedge funds that depend on the behavior of like the economy of China to be able to figure out like what they should be investing in. Um, how these institutions have like used other measures that are unconventional, that are not standard for measuring how the economy is working, because they just can't trust the official numbers from the country's like institution that's equivalent to our Bureau of Economic Analysis. And again, that just reflects that the reliability of these indicators is sort of is directly correlated to the level of development. China, although they exhibit huge growth, are not considered a developed country. They're considered a developing country. So it makes sense that their measures would be a little bit unstable with respect to truth. Anyway, so now we're going to revisit the circular flow diagram that we looked at in chapter 2, but it's going to be a lot more complicated now in order to capture a lot more of the complexity of the macroeconomy. So again, initially we talked about there being households and firms, and the households and firms interacting in factor markets and the market for goods and services. So households bought goods and services from firms, and then firms bought the factors of production from households. So we assumed that households owned the capital, which is like the productive resources that include like buildings and machinery. Also, they purchase labor from households. So households obviously have the workers. So firms pay the households wages and the price of capital, which is called the rent in economic theory, via these factor markets. And so we have the money going in this direction, which then the money goes to the market for goods and services and then comes back to firms. And then we have the goods and services going in the opposite direction, where firms are producing goods and services, they're going into households, and then households are selling their goods and services, their capital and their labor, to the firms via the factor markets. So that was like the basic construct that we looked at. Again, it included the flows of money, goods and services, and factors of production. So here we're going to focus on money flows and other key concepts that help to understand national accounts. So the underlying principle is that the inflow of money into each market or sector is equal to the outflow of money coming from that market or sector. So this reflects one of those principles that we established in chapter 1, basically that everybody's spending is somebody's income. All right, so again, we've got consumer spending that comes from the household. They spend money on the goods and services that are produced by firms and sold in the goods and services market. Consumer spending is household spending on goods and services. We can also throw in the rest of the world into this circular flow diagram. Now, the rest of the world plays obviously a role in all of our markets. They sell stuff to us, they buy stuff from us. So the rest of the world also buys goods and services from us in our market for goods and services. So we export to them, so they are buying our exports, and we are getting their money. Now, we also know that households own factors of production and sell the use of these factors of production to the firms receiving wages, profit, interest payments, and rent in return. So again, firms buy factors of production from households, and they pay them wages, profit, interest, and rent. So the wages are paid to the laborers. The rent is paid for the capital that they buy or rent from the household. So again, the household, the machinery, the buildings. The profit is paid in dividends from stock ownership that households hold in firms. So stocks are claims to an income stream, right? So if you own a stock share of a company, then you own a claim to part of their profits, and that is paid out to you from as in the form of dividends. And that's what this profit is here. It's paid as dividends to households. And then finally, we have rent, which is the price of capital. So capital, again, is the productive resources, and the price of it is called the rent. And we have a very specific explanation for that we'll talk about later in the course. All right, households derive additional income from their indirect ownership of physical capital, like I said, used by firms mainly in the form of stocks and direct ownership of bonds. So that's where the interest comes from. It's the bond. So a bond is a promise to pay back. So if you buy a bond from the government, you're loaning money to the government, and they are promising to pay you back with interest. Also, companies, firms, private organizations also issue bonds whenever they need money, and they're like, let us borrow money. And the way they do that is like they'll issue bonds, and then whoever buys the bond has a claim to that, both the amount the bond is valued at plus the interest that you're supposed to get on it. So that's where the interest comes from. Households own bonds from firms. So again, a stock is a share in the ownership of a company held by a shareholder. A bond is borrowing in the form of an IOU that pays interest. So you can have private bonds, you can have public bonds. Like California is trying to fund this like high-speed rail across California, and one of the approaches to trying to raise the money is to issue a bunch of bonds. So they'll issue a bunch of bonds, people will buy them, the state will promise to pay them back, they'll use the money to create the train, and then the revenue they gain from the train when it actually is operating, people pay to use it, will be used to pay back people and the interest. Obviously, it's not a perfect system, and there's complexities there, but that's how a bond operates. All right, so households don't get to keep all the income they receive in the factor market. So before, when it was a very simple world in which we only had households and firms, we did assume that all the income just kind of flowed in one direction, and it went from firms to households, and that was it. But obviously, in reality, that's not it. There is a government involved here. So if we throw in the government into our circular flow diagram, then we can demonstrate that some of that money that households earn is given to the government in the form of taxes, right? So they tax our wages, interest, rent, and our profit. And so some of our income is taken by the government. But that's not the end of the story with respect to the connection of the households to the government. The government does also return money to households in the form of what are called government transfers. So government transfers are payments by the government to individuals for which no good or service is provided in return. So you can think of like Social Security, Medicare, unemployment, food stamps, welfare, things of that sort, where the government is giving money to households, all falling under the rubric of government transfers. So then we've got this very specific type of income definition that we use, and we're going to use in this class, and that is disposable income. So disposable income is equal to income that households gain from factor markets plus their government transfers that households get from the government minus the taxes. So that is disposable income. And it's the total amount of household income available to spend either on consumption or to save. Yes? Well, tax returns, you mean like the tax refunds? Yeah. Yes. Yeah. All right, so households don't normally spend all of their disposable income on goods and services. They do save some of it sometimes. So private savings is equal to disposable income minus consumption spending. And so it's disposable income that is not spent on consumption. So again, disposable income is income from the factor markets minus taxes plus government transfers. So that's our disposable income. And then part of that is used for consumption, and the part that's not used for consumption goes into private savings. So again, everything we're defining here is like macro. We're talking about in the economy as a whole. So that's how you should be thinking about these things. Don't try to think about individual cases or like exceptions or anything of that sort, because then you will complicate a simplified version of the economy, which we use on the macro level to understand the overall workings of it. And so that's how you need to look at it. You need to follow the definitions that I'm giving you and just kind of like understand the economy through this vocabulary, through these concepts, without bringing in your understanding of the economy, without bringing in your understanding of the individual components, because then you will bring more complexity into something simple that will then muddy the waters of understanding for you. So you've got to like just go with my definitions. Disposable income equals income minus taxes plus government transfers. That is disposable income. Private savings equals disposable income minus consumption spending. Now, we don't just interact in the market for goods and services and the market for factors of production. We also interact in financial markets, where money is where it's lent and borrowed. So the financial markets include the banking, stock, and bond markets, which channel private savings and foreign lending into investment spending, government borrowing, and foreign borrowing. So that's where like all the transactions occur that are merely meant to move around like our money. So we've got households, their private savings go into financial markets, right? So households save their money in banks and then banks lend that money out. We've got foreign lending and purchases of stock. So the rest of the world will also lend money in our financial markets. So they'll have savings in our banks, and then that will be lent out. Or they'll purchase our stocks. We've got government borrowing. So the government will borrow from our households and the rest of the world in financial markets. And they'll do that by selling bonds. So when we talk about all this debt, all this money we owe to China, it just means that they own a lot of our bonds. And that helps them actually, because it's an asset that they have that then can be used as collateral, so that other countries trust them to do business knowing that they have these assets. So in case something goes wrong, then at least the country is able to pay back anything with these bonds that are not linked to their own economy. So all this stuff you might have heard over the last decade about like, we owe all this money to China and it's a problem. Like, it really wasn't a problem. They were buying up our bonds, and therefore us ultimately owing them money as a result, because they needed it in order to have credibility, in order to be like a stable like financial member of the worldwide economy. But over the last few years, like, they've actually sold off a lot of those bonds because they needed to, because their economy started kind of wavering a bit, and they needed to get rid of them a bit in order to satisfy some of the investors that started to pull back. So again, our government will sell bonds, and that means that they are borrowing in our financial markets. So the rest of the world also borrows from our financial markets and buys our stock. And we buy stock from them. All right, where am I? Here I am. Okay, so borrowing and stock issued by firms. So firms also sell bonds in our financial markets and stocks, and so they'll receive money for those. And that's what's happening over here too with the foreign borrowing. So there's foreign firms that are selling their foreign stock in our financial markets as well as their foreign bonds. The government uses its revenue and borrowed funds to buy goods and services. So the government will also interact in the market for goods and services. And that will encompass the government purchases of goods and services. So that is the part of the spending that occurs in the economy that's on behalf of the government. So government purchases of goods and services are total expenditures on goods and services by federal, state, and local governments. As you know, there's a federal government, and then each state has their own government, and then each city has their own government, and you could have like smaller municipalities within a city that might have their own governments. All right, so the rest of the world participates in the U.S. economy in 3 ways. So the first way is some of the goods and services produced in the United States are sold to the residents of other countries, right? So that's what we're talking about over here, exports. Goods and services are sold to other countries that are produced domestically. Some of the goods and services purchased by residents of the United States are produced abroad, and so those are, of course, imports. So we pay the rest of the world for their goods. So imports, again, are goods and services purchased from other countries. And of course, the third way that the rest of the world interacts with our domestic economy is foreign borrowing and lending, which is happening over here. So they're borrowing money from us, and they're also lending money to us. It took me forever to make these slides, by the way, to break this thing up and just like kind of present one piece at a time. It took me like a week. Oh, thank you. Yeah. Yeah. We and the government as well. Right. So the rest of the world will sell goods and services. And so for us, those are their exports, right? I'm sorry, no. So the government, sorry, you got to think about the arrow. So the arrow is where the money's going, right? So they're buying our goods and services. So we're selling exports to the rest of the world, and they are paying us money. And then also, we are paying the rest of the world for the things that they're producing. So they're bringing in imports into our market for goods and services, and we're paying them for that. So, yeah, got that? All right. So firms, the businesses in our country that produce, they also buy goods and services in this expanded view of the economy. So that's something we didn't take into consideration in the original circular flow diagram. We didn't talk about like the fact that like producers of goods and services also buy components of their goods and services from other firms. So the things that are sold to us are called final goods and services, and the goods that firms sell to each other are called intermediate goods. And again, those are components to the final goods and services. So like there might be a company that produces a car engine, and then the final producer of the car will buy that engine from them and put the car together and sell it to us. And that's how that works. So firms also buy goods and services. So inventories are stocks of goods and raw materials held to facilitate business operations. And that becomes relevant when we think about what investment spending is, which is represented by this arrow here coming from the firms. So they're spending money in the market for goods and services, and they're getting goods and services in return. So the spending that firms are doing is called investment spending, and it's spending on productive physical capital, which is like machines and buildings and things of that sort, and construction of buildings, and on changes to inventory. So if they are increasing their inventories, then that is considered investment spending, positive investment spending, and they are decreasing their inventories. That's considered negative investment spending. So again, inventories are stocks of goods and raw materials held to facilitate business operations. So the national accounts. So again, like the sort of equations that account for all this spending and who's doing what and how we can total all of it together into like some measure of total output for the economy. The national accounts count this investment spending as part of total spending on goods and services. So even when firms are increasing their inventories, that is considered part of investment spending. So changes to inventories of finished goods are counted as investment spending because, like machinery, they change the ability of firms to make future sales. So if they're increasing their inventories, they are facilitating future sales in the same way that they are facilitating future sales by buying productive capital, which will help them to produce to sell. This is going to become important, this concept of inventories being part of investment spending, when we look at this model. We'll look at it in a few chapters. So there's a reason why all this is being mentioned in such fine detail now. And there's always a reason for things being mentioned in this class. And in any class that's like very technical and like, you know, has its own like language, like everything that's talked about is usually relevant and important, even if it sounds like kind of like casual and like sort of you know, just something you can kind of gloss over. Like there's a reason why it's being talked about. So you should always like kind of keep that in mind and try not to like just overlook things. Anyway, so a drawing down of inventory. So if again, like if a company is like has inventories in their warehouses and all of a sudden their demand is beyond what they expected in any particular period. So anything that the amount that they produced in a particular period isn't enough to satisfy demand. So they have to go into their inventories to satisfy demand. So a drawing down of inventories, when they do that, when they're selling off some of their inventories, count as a fall in investment spending because it leads to lower future sales. So when you have those inventories being drawn back, we call that negative inventory investment spending, which we'll talk about in fine detail later on. All right, investment spending includes spending on construction of any structure, regardless of whether it's an assembly plant or a new house. So if a new house is being built, that is investment spending. Like a plant, a new house produces a future stream of output, housing services for its occupants, and that's why we can consider it part of investment spending. So adding up consumer spending on goods and services, this arrow over here, investment spending, this arrow over here, government purchases of goods and services, this arrow over here, and the value of exports minus imports gives us a measure of the overall market value of the goods and services the economy produces, which is gross domestic product, which is GDP. All right, so we're finally where we intended to go. Gross domestic product. So again, let's talk about this concept of final goods and services, or goods and services that are sold to the final or end user. And that's different from intermediate goods and services, which are goods and services bought from one firm by another firm that are inputs for production of final goods and services. So gross domestic product is the market value of all final goods and services produced within a country in a year. So this is the formal definition here of gross domestic product. The market value of all final goods and services produced within a country in a year. Yeah. Well, it could be, and that's why you just focus on one country and focus on their prices. So each country will have their own Bureau of Economic Analysis that will measure their GDP based on their prices. So adding up the total value of final goods and services produced isn't the only way of calculating GDP. So gross domestic product can be calculated in 3 different ways. So since GDP is equal to the total value of final goods and services produced in the economy, it must also equal the flow of funds received by firms from sales in the goods and services market. So all spending in the economy is somebody's income, and therefore If we look at the value of all goods and services produced in an economy, which is GDP, all of that is being paid for to somebody, right? And so therefore we can then, you see this new arrow here, GDP, we can say that the value of what is spent on goods and services by all the players that wind up spending in the economy is also equivalent to GDP, our gross domestic product. Which brings us to this concept called aggregate spending, the sum of consumer spending, investment spending, government purchases of goods and services, and exports minus imports. It is the total spending on domestically produced final goods and services in the economy. So a second way of calculating GDP is to add up aggregate spending on domestically produced final goods and services in the economy. So it's the value of all these things, it's also the spending on all these things. A third way of calculating GDP is to sum the total factor income earned by households from firms in the economy. So remember, the money paid for these goods and services goes to firms, and then firms use that money to buy the factors of production from households, right? And so then the sum total of those payments is also going to be equal to GDP. So $10 for a shave, barber's income of $10 equals consumer spending of $10. So again, this just reflects the fact that spending is equal to income. So again, three ways of calculating gross domestic product. One, add up the total value of all final goods and services produced. Two, add up all spending on domestically produced final goods and services. And three is to add up all total factor income earned by households from firms in the economy. Three different ways of measuring GDP, all equivalent. All right, let's just cut it off there, and we will jump back on this next week and do, of course, a quick review of everything we covered. I'll go back. So yeah, have a great week. I will open up chapter 6 homework, and that's it. Have a good one. I'll see you next week. Take care. Take care. Hi.
I'm the girl that emailed you about being absent the first week of class.
Okay. You have to
like
understand, I get a lot,
yeah, I know,
and that's why I don't want people to email me.
Yeah, it was
But
just like that personal email. But I have a quick question. So for the homework, I think some classmates just told me we have chapters 1 through 3 due this Tuesday.
Following Tuesday. So today's Tuesday, so that's in a week.
Okay, and then 1 through 6?
Well, 6 also. So no, not 1 through 6. It was like 1 through 3 and then 6.
So 1 through 3
and 6.
And 6 on Tuesday.
Yeah.
Not Sunday?
Not this week because of the add drop stuff. I wanted to, in case somebody was going to add late, I wanted to give them a couple of days to do it.
Okay, so it's this Tuesday. Well, next Tuesday, a week from today.
Yes.
Okay, great.
Ideally, you would have been doing it already.
Yeah.
But but you do have this one sort of like time period where you have a little bit of extra time. So.
Okay.
And then of course you have the solutions, which I offer in video format, right, on Moodle.
Yeah.
So it's not hard, but you have to spend the time to like go through each question, and the point is to understand and learn. So you want to spend time on it. Like you don't just want to like get it done, submit it just so it's done. Right?
Sure. Okay.
So do your best.
Thank you. Have a good night, okay?
Take care. Good luck. You too.